4 years on from the financial crisis, Wall Street is still grasping for a new business model. Apart from a weak global economy, banks also have to contend with new regulatory pressure. How do they make money from those business lines that were once extremely lucrative, but now are suddenly hit by capital charges that makes the whole game much harder to play?
Well, banks need to improve their return on equity because right now many banks are not exceeding their cost of capital. When they don't exceed their cost of capital, the stocks of the big banks trade below book value, which is the case today. So whether or not banks can exceed their cost of capital is the $1 trillion question.
The business models have changed. The street isn't being able to beat its cost of capital. They know that derivatives profitability is going away, proprietary trading profitability is going away. The balance sheets are not going to be as good a source of profitability going forward.
But there's a rethink taking place, and that rethink says, instead of pushing so aggressively to increase the return on equity, let's reduce the cost of capital. And the way you do that is by de-risking and having more strong balance sheets, more predictable earning streams. And if that's the case, then the end result is not only happier regulators, because the taxpayers and the governments would be better protected, but also happier investors because the valuations would be much higher than they are today.
With everything changing, how can Wall Street make really radical decisions? And they're not. I mean, what they're really doing is they're suffering through a period of low returns, almost as if this is an option.
Revenue growth this decade is going to be the worst it's been for any decade since the decade of the Great Depression. So if top line is weak, the only way to make it work on the bottom line is through efficiency.
What you're going to see is various firms responding in different ways. Those that rely on derivatives are going to have greater problems than those that rely on equity execution with large equity underwriting. That's still going to be a good business. Those that rely on proprietary trading are going to face a real challenge. They're going to have to shift more towards governments because I'll still be able to do proprietary trading in governments. And they're all trying to maintain the capability because they really don't know what the future is going to be.
Bank managements always want to improve the return on equity, always want to have a faster growth rate, always want to go into the new products. Well, guess what? The next big new thing in the banking industry is what's old. And what's old was 1950s style banking, where the result, the output of the banks was utility-like, where you didn't have to wonder if your bank was going to be there from one day to the next.
As Wall Street executives work out how to adapt to these new challenges, they're choosing different paths. Morgan Stanley behind me is opting to go more into retail brokerage, selling stocks and bonds to ordinary Americans. Goldman Sachs is doing a more delicate fine-tuning of its fixed income operation. But what the banks have in common is that they're all cutting bonuses, cutting people, and moving into electronic trading in a bigger way, all in an effort to boost returns on equity and convince investors that this is a sector they want to be in once again. This is Tom Braithwaite for the Financial Times in New York.